Hey, Mike. Today we have Rob Moore from Everman Wealth and Prosperity out of Virginia. He's a military planner like we are, and I think we have a really good topic today. We're going to be talking about the newest characteristic of the thrift savings plan. So now TSP, you can do in-plan Roth conversions. People have been talking about it a lot. So we're going to dig into the ins and outs of who might want to do one, maybe who shouldn't do one, and sort of the framework around it. So I'm excited to jump in with Rob today.
Yeah, great conversation. Stick around to the end. Make sure you get all the knowledge and a lot of warnings on, hey, when is this not appropriate, or what do you need to know before you think about doing one of these? So yeah, it's a great conversation, and here we go.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
So today we have Rob Moore with Everman Wealth and Prosperity out of Virginia, to talk to us about TSP in-plan Roth conversions. This is a long-awaited feature of the TSP plan. It finally rolled out this year. So we're going to hear from Rob on the ins and outs of who should do those, when, the tripwires that are out there. But before we get started, Rob, how about if you tell us a little bit about your path into the industry and a little about your firm and yourself?
Yeah, sure. Hi, Mike. Hi, Amy. Really proud to be on the show with you. As a friend and colleague, it's nice to join you in this venture here that you guys have built. But yeah, thanks for having me, and thanks for allowing me to talk about my situation, my business a little bit. But yeah, I started the journey probably 5 years ago. I guess is when the clock started ticking. Spoiler alert for the 5 year clock that we'll probably talk about with Roth conversions. But it's been about 5 years. I started out with a general finance degree. I was in the Army, retiring actually currently right now, but I was in the Army in a field that, let's just say, not entirely lucrative when it comes to going on to a second career. So it's like, well, what do I think about all the time that makes me happy? And money was at the top of it, and not the way money as far as like buying things, but just how it works and how to efficiently use it. So I started a general finance degree, stumbled upon the CFP path, the designation, found out about that. And so I finished that degree, did the exam, launched the business, just hit 2 years. So I launched January 2024 is when it started. So I'm in my third year. Things are going well. So yeah, I've just been spending the last couple of years growing the business and helping people out. It's just a wonderful feeling helping people with their money. And also just growing another passion that I love, and I feel so purposeful about, like how many people in this world can have two careers with that much purpose, the military and something like this. So I really found something joyful and looking forward to the future.
That's awesome.
That's
Yeah,
awesome.
thanks
Yeah.
for being here. No, it's a great journey, and always love to hear what how folks transitioned, and yeah. So again, as Amy said, we're going to talk about the TSP new feature, which is always kind of cool. But Rob, let's take a quick step back. Just within the TSP, there are two kind of flavors of accounts. Can you briefly describe those?
Yeah, sure. So what you're talking about is the traditional, well, what people call the traditional, right? So interchangeably, it's like traditional or tax deferred, or just the regular variety, I guess the vanilla side. You said the different flavors, but it's the normal side of tax deferred account, otherwise known as the TSP, traditional TSP or tax deferred TSP. It's just that normal, that if you sign up for the TSP, it's that first thing that people think of. And then on the other side, the other flavor is the Roth TSP, the other side. It's There's a lot of ways you can describe how these are different. If you understand how a traditional IRA and Roth IRA are different, then you already understand how it's different when it comes to the TSP. It's very similar. How I try to describe it in as simple as possible is when your money is taxed. I kind of start with that. So with the traditional or the tax deferred side of the TSP, I like to describe it as the TSP intercepts your money before it gets to your account. All right. And that's from a tax perspective. So, you get paid by the military and the TSP takes out a little bit and then you get your income. And the reason why that's helpful is because that helps you understand I'm only going to be taxed on what I get, what I actually receive after the TSP takes the cut and invests it for me. Now, that money in the TSP is still yours, but it's tax deferred. You don't owe taxes on it yet. And then when it comes time to take the money out under qualifying terms, then you're going to be taxed on everything you take out. So you're going to take out, the contributions, the earnings, everything is going to be taxed as income. Now, with the Roth, my analogy fails a little bit because they're still going to intercept the money, right? The TSP is still going to take it. But in effect, you have to think of it as if you've received it and you're giving it to the TSP from a tax perspective. In other words, you do have to pay income tax on anything you put into the Roth TSP at the time you defer into it or at the time you contribute to the Roth TSP. So if let's say you contribute $10,000 to the Roth TSP this year, you're going to have that $10,000 worth of income you have to pay taxes on this year. Now, the rub on that is when you go to take it out, again, under qualifying terms, it's all tax-free, everything you take out, under qualifying terms. And there's other wrinkles to that. But, in a nutshell, it's basically what it is.
Okay,
thanks for walking us through that.
And so, before we dive into like the TSP version of things, what is happening if somebody is going to do a Roth conversion? Can you just walk us through that step by step, like the basic, what it really means?
Sure. So the really nice thing about the Roth conversion in the TSP is it's a feature a lot of folks have been waiting on. Because with an IRA, you always have had this, well, not always, but you've had this conversion opportunity for a long time. With the TSP, it's brand new. So what happens is, if you've done a really good job saving into the traditional side of the TSP, and then you've learned about the Roth account, or maybe you've hired a professional or started doing tax projections, and you're like, hey, I would rather have a lot of this in the Roth side. Up until 2026, you couldn't do anything about it. Now what you can do is called a Roth conversion, in plan TSP Roth conversion, where you can take some of the money from the traditional tax deferred side and just move it over to the Roth. It just gets relabeled as Roth, moved over, and then it starts to grow at that tax-free at the end, again, qualified distributions, it becomes tax-free at the end of your life, or when you retire and you start to take distributions. Now, there's a rub to this, there's a catch, that every dollar you convert in the year that you convert it is taxable income. So that's something I think is really kind of at the heart of the discussion of why, when, how, and why you would consider doing this.
Yeah, that's a great, summary of what you're doing. Taxable in the year you're doing it, but then eventually continues to grow and never have to pay tax on it again. So, have you actually done any of these or played with the thing on the TSP to actually do it? I haven't done an official one, but I kind of walked through all the steps just short of hitting submit and thought it was pretty straightforward.
You'll laugh. I did one this morning in preparation for this. Yeah. I was like, well, I better figure this out. And I know my clients will probably take advantage of it. But the guest you had on previously, my buddy Oman, in the last episode, he had done it as well. And he told me, yeah, it's super painless and straightforward. So yeah, I did it this morning. Just some thoughts on that. It went really fast. Now, granted, I knew what I was doing. But so I didn't take the time to read all the fine print disclaimers. But when you get on, the first thing I noticed is on the left-hand side of the TSP page. I guess I should say that first. When you get on the TSP platform, the website, on the left-hand side, there's a tool that you can go and do a little playing around with a calculator, a Roth TSP in-plan conversion calculator. It's really great. But up at the top, there's a menu item that says Convert to Roth. I mean, it's very straightforward. Click on it. And then it brings you through probably about 5 different web pages. You click through, you enter information, how much you want to do. But what I thought was really great is throughout the entire process, they were really adamant about telling you were going to be taxed on this year. They will not allow you to go through this without like, hey, idiot, you're going to be taxed on this year. And there's other, I'm sure we're going to talk about that wrinkle, which is kind of maybe could be confusing and complicated, but they don't let you get through the process without warning you. You have to acknowledge. It's very clear about how much you're contributing over, gives you an opportunity if you wanted to do a quick calculation on your marginal tax rate to see how much you would owe in taxes, but it's all there. Like I said, I was done in 3 minutes. I converted $1,000 over. It was painless.
No, painless. You said painless. It is painless right now.
Yeah, good point. Yeah.
But let's talk about what could happen. So there's calculators and things like that. But sometimes I feel like, especially if you don't understand how the calculator works, the calculator might not give you the right answer. So,
Right.
making sure that you really are getting all the right information into the calculator. So let's talk about what really happens with taxes. Now, $1,000 is probably not going to sink anyone, right? You'll probably, worst case, nobody pays 100% in taxes, so it's less than $1,000 is what you're going to owe on that conversion. But let's take a bigger number, like $100,000, and let's talk about how that impacts your tax return and what that looks like on your tax return.
The most basic thing you need to think about when doing a Roth conversion, really of any kind, it's not just TSP, IRAs, same thing, 401k plan, is the amount that you're putting in, that you're converting, is added on the top of your taxable income for the year. So start there. So let's say, did you say 100,000 or let's do $100,000? Yeah. So, okay. So we're going to do $100,000 Roth conversion in plan TSP. That is going to be stacked on every single dollar of income, gross income that you've earned in 2026. And it's going to be reflected in your taxes when it's due. So the most basic strategy that you want to have in place when doing this is, use some calculator or Dinkytown, or maybe refer to your old tax return from last year. If nothing has changed, everything's kind of the same this year, to get an idea of where you are and what tax bracket you're in, marginal tax bracket, not average tax bracket, but your marginal tax bracket. And then let's say if you're in the 12%, then most likely that $100,000 conversion is going to cost you $12,000 in taxes this year. Now, there's other hiccups here too. You have to have access, first of all, to that $12,000 to pay the taxes. You have to, you can't take it out of the $100,000 you're converting. You have to have that money on hand. The other thing, and I'm sure we'll get into this maybe a little later, is be careful. It might bump you up into the next tax bracket. So you might go from the 12% up to the 22 and not realize it. There are guidelines, I won't get into it now, called safe harbor. You have to abide by. Most people, it doesn't affect them. But this could put you in a lot of trouble when it comes time to file taxes. Even if you had the money to pay the taxes, you might still be in trouble because you didn't maybe do the prepayment, a quarterly payment or whatever. There's a lot here that you have to get in trouble, that you could get in trouble with. $100,000 is quite a sum. I would reach out to a pro if you're considering doing that.
Yeah. Well, because it isn't, yes, the marginal tax bracket, but then now you get into phase outs, and the phase outs got so much more complex with One Big Beautiful Bill Act last year. So you might phase yourself out of something you thought that you weren't going to be phased out of. And then you might phase yourself into, not phase, but you might bump yourself into net investment income tax. So it isn't just your marginal tax rate, it's that 3.8%. You might bump yourself into extra Medicare tax or FICA tax. So it is a little bit complex. So I agree with you. If you're going to go down the road of doing a pretty big conversion, it might be a good idea to touch base with a professional to help walk you through all the rules. Because sometimes the straight marginal bracket might not, it might give you a little bigger surprise than you thought.
That's a really good point.
Not even less easy than just the $12,000.
And so, you're talking the big conversions here, and people are like, oh, this is available. Let's, just convert the whole amount. Why is that not often the best strategy, even if you do want to eventually get a lot of money into the Roth side of your accounts?
So when you think about getting money over to the Roth side, there's a couple of ways you can look at it. With my clients, we do a kind of a long-term projection of, we did it every year up to a certain amount. We kind of see how that affects things. But every year we do an individual assessment as well. So even though the long term says, okay, you should do X amount per year for so many years, it always varies depending on your year. So this year might not behoove you to do that, or it might actually go above it. There's a couple different strategies you can pursue, but it really depends on the year. It's really helpful to do that end of year tax planning to avoid that stuff, Amy, like you talked about, losing out on phase outs and seeing how it's going to affect different things. But generally speaking, if you're within a bracket, you want to avoid jumping to the next bracket. You want to avoid missing out on, or going into phase outs you don't want to go into. So if you smooth this out over time, it's probably going to keep you in a safer space than spiking income in one year.
That makes a lot of sense. Now, if for deployments, there's a lot of tax planning that people think through when they're deployed. Do you think that it's probably a good time to convert during deployment years or during deployments?
Yeah. So are you talking about combat zone?
Yep, exactly.
Yeah.
Yep.
Yeah. It's such a great opportunity to do this type of stuff. You can do a lot of different things in a combat zone to take advantage of tax, optimization. With the carve out that it might not be the most fun time to think about taxes while you're in a combat zone. Not that there is a fun time to think about taxes, but there's just so much potential to squeeze out of this that, like if you're a service member, if you're married and your spouse doesn't work and you have no other, forms of income and you're in a combat zone for the entire year, theoretically speaking, your taxable income could zero out and you have nothing. So think about that. You've got a potential, you've got this standard deduction of $32,200 in 2026 that you're not going to pay taxes on. So guess what? You could do a Roth conversion of 32,200 and that's going to take you up to the standard deduction and you're still not going to pay any taxes on it. On top of that, you've got the 10% tax bracket. You could fill that up too and, do a conversion and save a ton of money while your taxes are, I guess, theoretically low. Even though your income's robust, your taxes are artificially low. So it's a good opportunity to do it.
Yeah, I agree. And sometimes you can, there's other reasons you might want to get income on your return for those deployments as well.
Yeah.
So yeah.
And Rob, a lot of the general conversion advice is targeted for folks after they've retired. Typically, they call it the sweet spot between retirement and actually claiming Social Security. Because again, a lot of folks' income really drops there. How might that be different for military folks that have retired? And what do they need to think about when they're kind of doing those long-term projections that you talked about?
Yeah, as military planners, we see this a lot, right? If you have the civilian side of things where people are, they're doing the 401k and earned income for their whole year or their whole life. And then when they retire, they've got this valley. It looks like a valley when you look at the tax projection that drops off when they stop earning and a lot of their income drops off tax wise, paper wise. And they've got this really sweet spot between that and let's say maybe a pension kicks in later or Social Security, et cetera. That you have this valley of federal tax rate that you could do a lot of Roth conversions in that valley and get it over on the cheap. With military, we've got a complicating factor called an immediate pension that starts when you retire if you do the 20 years. So it's a good problem to have. But as you look at a military service member with their projection, the federal tax rate, it drops, but not as much, right? It dips down a little bit. So a standard service member that does the 20 to 30 years has the pension, their long-term tax projection is going to be a lot more smooth. Now, it doesn't mean that Roth conversions aren't a good idea. Some of the things I found is, it maybe just brings the need or the opportunity closer to the present. So instead of waiting till they turn, maybe 57 and 58 and they stop working, you could do some now and, get that benefit in the long term.
Yeah, that's a great point. Because it definitely, like you said, having that long-term plan and just thinking through what does this really look like based on how long I think I'm going to work and, what other income sources I have at different points along the way, can make the immediate oh yeah, this does make sense to do some small amount
Yep.
immediately. So yeah.
Yeah.
Well, and the other weird thing that happens for us too is, a lot of us, like us, we all retired from the military, but we all have jobs. So there's a really good chance that, people's tax brackets go up when they retire,
Yeah. Yeah.
which is weird compared to the private sector. And then it might drop off and maybe there's a valley there depending on what career and things like that. So it's a really different kind of tax planning situation for military people versus civilians. Um,
Can I add one more thing to that? So I mentioned how, a lot of times the military taxation it's kind of their burden smooths out over their entire year. We don't see necessarily the peaks and valleys. Well, maybe aside from folks that get that second career. But what I've seen recently a lot of times is maybe, with a 30 to 35-year-old service member that has done an amazing job saving into their TSP. I mean, they are cramming money. They're maxing out their TSP. They did it ever since they got in. It's amazing to see. They're in a really great position financially for the future. However, even though they might be in the 12% tax bracket and we might project that out all the way up until in their 70s, guess what happens when they turn 73? Even if their standard of living stays the same, they're not going to be pulling massive amounts out of their TSP. When they hit 73, the IRS says, okay, it's time. You have to start taking the required minimum distributions. And then all of a sudden, they're in a tax bracket potentially that they've never been in their entire life, right? So that's one benefit of the Roth side of things is there's no RMDs. So if you can get money over there, way we can continue that smoothing of the tax bracket out until the end of their plan.
Yeah, and I see that actually a lot. A lot. I see military retirees who had a second career. They did a good job saving. In a lot of cases, the Roth wasn't even offered until 2012 or something like that. So a lot of times you had no choice but to go to traditional. And so a lot of people do end up in that highest bracket later. And it's not just the tax bracket, right? We have TRICARE for life, which means we're going to pay for Medicare Part B. And so a lot of people end up paying, you know, more than the minimum amount for Part B. So it becomes a big planning opportunity if you have enough time.
While we're on the topic, there's another bucket to consider. People, they say, well, I don't know whether to do traditional and or Roth. And I see a lot of people with a huge amount contributing to their TSP or their 401k. It's like, well, you don't have much in a brokerage account. And that has its own tax advantages in the future. I know that's not part of this episode, what we're talking about. But if you do feel stuck and you're like, okay, I'm just cramming massive amounts into a tax deferred retirement plan. Well, you need money maybe in the meantime too. So a brokerage account is unique in that way. But again, I'm far afield of our point that we're talking about. Yeah.
Well, let's turn to we don't often talk about blended retirement system because we're still lots of legacy, but there's lots more people who are now part of blended retirement, and they are getting the match, which automatically goes into traditional TSP. Do you think it might ever make sense for them to convert that match while they're still in uniform?
Maybe you guys have put more thought into this than I have, but I wouldn't treat that any different than just normal funds that you've contributed to the traditional side of the TSP. What do you guys think about that?
So, I mean, I think if they're like contributing to the Roth, and especially if they're a, more junior enlisted where their income's low and they're in that 10, 12% tax bracket and, that small 5%, if they could, start doing that every year while they're still in those super low tax brackets, that I think is going to be, hugely game changing, especially if they, you know, again are super savers and grow later when they're in higher tax brackets, start moving bigger sums into 401ks that are tax deferred and things like that doing that stuff early while they're in those super low tax brackets makes all the sense in the world to me.
But
Yeah.
you
And
wouldn't so you wouldn't, but you wouldn't, that all makes sense. I agree with you, but you wouldn't necessarily treat any traditional TSP side funds any differently just because they were a match versus money you put
No,
in. Right.
No, this is more in the, hey, I'm contributing to Roth because I am in the 10 or 12% tax bracket, which I don't, for I find it hard to see how it's going to get much lower than that in the future. So if they're in
Right.
that bracket, all their stuff should be going into Roth, but the match has to go into the traditional side first. So now's the time to just start moving that over again, fill up those lower tax brackets. And yeah, if they've got, they've been in BRS for a while and unfortunately, haven't had the opportunity to convert. Okay, let's again space that out. Every year we're filling up the 12% tax bracket at least, and doing that over time to again drive that down and get that money into Roth as soon as possible.
And I mean, just like Roth conversions, and we do this all the time with our clients, right? Is when's the right time to do a Roth conversion? Well, when you're at your lowest tax bracket.
Mhm.
And we can't know that with certainty, but we can make some fairly educated guesses with, modeling out, income and projected required minimum distributions and things like that. And I think the same applies for the match. I agree with Mike. We're probably not going to see rates that are lower than 10 or 12%. And okay, so if you are in the 10% bracket, yes, you've given up some tax money now, but you've also hedged your bets against future tax increases, or maybe things going better than you thought, or maybe a parent passes away and leaves you an inherited IRA that you have to pull out at not a great time, things like that. I think it might make sense. Um, One of the things that sometimes we forget about, because a lot of times as active duty service members, we don't pay state taxes for much of our career, or all of our career. How does the calculus change when the person considering the conversion is now retired and they live in a state, say California, New York, Maryland, New Jersey, some of those higher tax states?
Yeah, there's a lot to consider. And I kind of lump this not necessarily within an only a Roth conversion discussion. It's just more of a general discussion entirely, because when you retire, let's say if you're living in a state, you're stationed there, you're going to stay there, maybe your kids are going to school or whatever. When you retire, you become a citizen of that state, or a resident of that state, right? So you have to be aware of the changes that affect you. So if you've been hanging on to that sweet Texas residency or Florida, and you've been paying nothing in state taxes, not only will this affect your decision, to do a Roth conversion and how you're going to take distributions or whatever, it's going to affect everything. The other thing to consider too is localities and counties, things change. Or if you are going to move somewhere else, you can't keep the state residency you've had in the military. So wherever you decide to move, you move to Florida, well, then you're going to pay higher amounts of tax on any income. So if you do know that in 5 years you're going to move to California and you want to do Roth conversions, you have to add the difference in now, the savings of doing it now if you have a low income state residency versus doing it when you get out. Even if your income's lower when you get out, you have to kind of do that math. It's a lot of math involved to that.
Yeah.
Yeah.
Yeah, it's higher level calculus at that point.
Mm-hmm.
So and I think we somewhat hit this, but this, I think we've highlighted that this really isn't a one size fits all decision. Can you just talk a little more on how you kind of work through your framework with folks, and
Yeah.
what questions you'd kind of be asking as you go along to see if this makes sense or how much makes sense?
If you are doing that tax rate arbitrage between what you're currently paying in taxes and in the future, you might choose to fill it up. Like we talked about, fill up that 12% tax bracket. Do some tax planning. You have to do it before the end of the year. So go on Dinky Town or get a tax pro to help you. Try to picture how much room you have left in that marginal tax bracket. And if you've got $34,000 left in the 12%, then maybe you convert $34,000, right? That's like the traditional, I guess not traditional. That's the more normal strategy when it comes. There's a few other opportunities that go overlooked a little bit. So, Mike, going back to the original question of how I decide to do this with clients, sometimes we have clients that, let's say they've got a ton of money on the TSP traditional side, but not much at all on the Roth side. So we're getting closer to retirement. We don't have any tax-free buckets set up, and they don't have a lot of time to do it. Even though they're making a lot of money, we might still elect to do it. One of the opportunities we might do it is if we do their tax planning and they're expecting like a $5,000 tax refund. Okay, so now instead of filling up the tax bracket they're currently in, we're actually going to fill up the refund. We're going to do a Roth conversion to absorb that refund that they don't need. They don't need the $5,000 for cash flow. So we'll just do that Roth conversion and start to get more money over to the tax-free side to give them some options in the future. And finally, I guess one of the least conventional ways to consider or why you might do it is in a down market year. We've had like a market correction kind of looming out ahead of us for the longest time. It feels like it just feels like it's always out there. We're just waiting for it to happen. Well, let's say 2026, the bottom drops out of the market and we suffer, a 35% loss. Like that would be awful. It would feel terrible. Well, guess what? Not only is investing on sale, conversions are on sale too. So if you had 100 shares of XYZ and its current value is $100, and then there's a market collapse and you now that 100 shares is worth $70, well, guess what? You can still convert all 100 shares over and you're going to pay, 30% less in taxes to do it. So that's a little bit more of a theoretical, less conventional way, but there's a few different reasons why you might consider doing this.
Those are really good points, because a lot of times people are kind of driven by, maybe tax bracket or, something like that. But those are other good reasons. And just, we talk about diversification with what you're holding, what you're investing in. But to your point, diversification among account types, meaning traditional money, so tax deferred money, Roth money, and brokerage account money, that can also be a really good strategy to give you options later on.
Can I throw one
Now,
more on the pile?
yeah.
Sure.
Yeah. So there's also the tax-free gift to your heirs. Yeah, if you have a huge benevolent heart, and you're like, not only do I want my, or let me start with this. I'm not going to use all this money. Like if you're in retirement, like I've got more money than I know what to do with. It's all in retirement accounts. Then maybe you want to go ahead and start paying the taxes on behalf of your heirs. So when you do this conversion, get it to the Roth side, and I imagine maybe you don't even touch the Roth side of things. You're just piling money that tax-free, because guess what? When your heirs inherit that Roth IRA, they inherit it tax-free as well. So even if they're young adults and they're only the 10 to 12% tax bracket, mathematically speaking, it might be better to let them pay the taxes on it, but it might be a gift that you provide for them, right? It doesn't make number sense. It's more of a values decision.
Yeah. And that makes a lot of sense as well. Especially because, yes, they might be in a lower tax bracket now, but when you pass away, your kids might be in their highest earning years.
Yeah.
So it can be, a generational, I'll say generational wealth strategy. It's not, truly, but now we've talked a lot about fill up the bracket kind of concept. And I actually have a lot of clients ask me, what does that mean? So let's talk about what that means, because we're throwing that around and we're just assuming people understand what that is. But when you say fill up the 12% bracket, what do you mean?
Okay. So real quick, if you don't understand the difference between marginal tax and your average tax, okay, if you go in, if you divide the amount of tax you paid last year versus your taxable income, you're going to get what's called the average tax. That's not going to give you a clear idea of how much to expect when you're doing a Roth conversion. So if you do a Roth conversion of $10,000 and you look at the last year's return and you do some analysis, you're like, well, I had an average tax rate of 8.9%. So that I'm going to have 8.9% taxes on this $10,000 conversion. No, that's not true. You have to look at the marginal tax bracket. So that's looking at the taxable income and putting it in, just Google it, look up tax brackets and see where you fall. And if your taxable income is within that marginal tax bracket of 10 or 12%, you have to understand that the conversion amount is going to be stacked on top. So let's say you're right in the middle between the 10 and the 12%. So that means you're in the, or let's say you're in the 12% tax bracket. the $10,000 conversion is going to stack on top of your taxable income, and all $10,000 is going to be taxed at that marginal rate. It's what we call the next dollar rate. We talked about earlier, this is where you want to be careful about, or intentional, I should say, and understand if it bumps you into the next one. So let's say you do a $10,000 conversion, you're in the 12% bracket, but you only have $5,000 more worth of the 12% bracket. So the first $5,000 of that conversion is going to be taxed at 12%. Well, guess what? The next 5,000, because it's stacked on top, is going to be in that 22% bracket as it stands in 2026. So that might still be okay, but you need to be aware of it. And a lot of people do. They fill up the bracket. So maybe you stop at the $5,000 and you just like, hey, I don't want to pay more than 12% on this. So stop at 5,000. And I mean, if you go over by a couple bucks, not a big deal. But that's what that idea of filling up the bracket, and also just being aware of what bracket you're going to end up in.
Mm-hmm. Yeah, and I'll just point out too, there are Medicare brackets. So for those who are, through retirement, you're in TRICARE for life now. Medicare also has those brackets. Now, the tax bracket, so the 12% and the 22%, it's a little bit forgiving, because if you go $1 into the 22% bracket, fine, that dollar is just taxed at 22%. But with the Medicare brackets, if you go $1 into the next bracket, you're signed up. So you are signed up for that next level of Medicare premium. So some brackets are more critical than other brackets. So I'll just add that in there.
There's another one too. If you're savvy with taxable accounts and brokerage accounts, there's the capital gains tax brackets too. So well, I should say the long-term capital gains brackets. The short-term is income, but be aware of the long-term, how it might affect the next dollars coming out of your capital gains investments.
100%.
And that's key at that, especially at that really low level of the 12% tax bracket, because you think you're recognizing it, 15 or 22%. It's really like 27 because you're losing some other breaks and stuff. So yeah, it's important that you fully understand, or you're working with somebody who fully understands the whole picture and can really lay it out for you, so you don't get any rude surprises the next April. So one of the things, and we can just hit on it briefly on the strategy side, is just some of there's a couple 5-year rules that go with Roth accounts and doing conversions and things like that. Do you mind briefly walking through those?
Sure. It's, these are a little confusing because, and I think we have conversations about this too, like trying to understand exactly how it's applied. I'm going to start with this. When you hear about the 5-year rule, especially when it comes to conversion side of things, maybe don't let that wag the dog. All right. Don't be afraid of it so much, because what happens is you do this Roth conversion and becomes this imaginary clock that start ticking from January 1 of the year. So let's say you did 3 conversions in 2026. They're all going to be, the clock's going to all start on January 1 of 2026. So they're all treated with that same 5-year clock. So once you do the conversion, you have to let it sit and marinate for 5 years before you take it out. Otherwise, the earnings could potentially be taxed as income, and there could be penalties, et cetera. If you go over 59, my understanding is the penalty goes away, but if you don't satisfy that 5-year window, then the earnings could be taxed as income. Now, there's a couple things to think about. This can be an issue with TSP, because when you're taking a distribution from the TSP, you are getting a distribution, what they call pro rata. So you're going to get a mix of the contributions and the earnings at the same time. That's how the TSP does things. If you have it in an IRA, it's treated differently. When you take a distribution from the Roth IRA, it's not treated pro rata. Instead, you're getting the contributions back first. So even if you violated that 5-year window, the first monies you're taking out of the Roth IRA are all going to be contribution anyway. You're not collecting earnings yet. All of that, I guess, for lack of a better term, basis, gets collected first, and then you go into the earnings, even though they're still tax-free. The final thought on this, again, even if you violate this rule, it's going to be such a small part of your distribution. I'm not sure it's worth worrying about too much. And that said, if you're leaving it in the TSP and you're not rolling it into an IRA, the Roth side of things, the Roth bucket of your retirement accounts, is probably the last ones you're going to be touching anyway. So even if you did this later in your 60s, you did a conversion, and if you have a long time horizon, you have plenty of money in the traditional side, mathematically speaking, it benefits you maybe to wait to take out the Roth side anyway. So I don't see a lot of people running into this problem. And if they do, I don't think the quote unquote penalty of being taxed on the earnings is such a prohibitive thing that you might have to weigh. I don't know. Do you guys think if there's a situation where you would really have to heavily weigh this consideration?
Not really. I mean, I think it's more of, hey, just be aware it's there, and it shouldn't be something like, oh yeah, I'm going to, move this through and then I'm going to move it right back out, take it as a distribution type thing. And other than that, as long as they're thinking, yeah, this is more of a long-term play, just be aware there are some clocks you got to satisfy to avoid, potential penalties. But again, like you said, probably minimal, especially even if earnings get taxed. If it's been under 5 years, you're probably not going to have that significant amount of earning, unless you somehow picked that stock that went, vertical type thing. So yeah, and within TSP, that's not possible because it's, you got your 5 funds and the L life cycle one. So yeah, you're probably not gonna, see a giant amount of earnings that, oh no, I got to take this and it be a big issue. So no, I think you characterized it well.
I mean, I think the biggest thing with paying attention to that is that it's not so much that, I mean, we have had a couple years where we've been up 20%. So, depending on how much money somebody has, it could be, you know, a bigger surprise than they expected. But I think the real problem is like making sure that it's reported correctly on the tax return. So just understanding the rule, if you do, if you end up getting to those earnings, just knowing that it has to be reported correctly on the tax return, because you don't want to get in trouble that way. So I agree that this is probably not a huge deal. It's not. It's like the boogeyman, right? Maybe the boogeyman exists, but but you can probably manage the risk of the boogeyman, right?
We should probably also differentiate this 5-year clock we're talking about between the 5-year clock of each conversion against the 5-year clock of your Roth IRA in general, right? So I think people are probably familiar with that one. This is different. So just a side note, if you don't have a Roth IRA and you intend on using one, as long as you're within the conforming income limits to contribute to one, it might be a good idea just to open one up and get some contributions in there to get one rolling. So you satisfy the 5-year rule that applies to Roth IRA accounts as well.
At least as long as you're not phased out, because sometimes people
Right.
get caught up in the phase out. Okay, let's back up to something you mentioned it earlier. Now, a lot of folks do not like that they are going to have to come up with the cash to pay the tax on their conversion. So, if they do a conversion, it costs them $12,000. They've got to come up with the cash out of pocket. That can't come out of TSP. But how about if you fill us in on your thoughts on why that might actually be a good thing?
So the reason we're talking about is that you have to have the cash on hand in a savings account or a liquid account or available to you to pay the taxes. So the only other option there would be is if the taxes came out of the distribution itself. Excuse me, let me say that better. If the taxes came out of the conversion itself. So let's say that you did the Roth conversion, and I can't even remember if they even offered to allow me to take a withholding on that. I'm not even sure if it was in there or I didn't even see it. But some custodians do this. So maybe let's slide over to the IRA side. So let's say you're doing an IRA conversion, the math, everything works the same. And you go to the custodian that you have it with and you say, I want to do a conversion, and they do it. A lot of times there's an option to say, hey, do you want to withhold money in order to pay the taxes on this conversion? If you're younger than 59 and a half, I know there's disclaimers to say this is not financial advice, but do not do that. Like this is as close to like safe advice I could give. Don't take the withholdings out of the conversion, because what the IRS sees is they see a conversion, great, a taxable, and then they see an additional amount that they receive as withholdings, the IRS receives, but they don't see that as coming from you in your pocket. They come at, that's a distribution. So it's as if whatever your custodian is gave you that money and then you paid them. So what you've done is you've taken a distribution from an account when you probably are not eligible to. So not only could you be faced with taxes on that amount, ironically, taxes on what you chose to use to pay taxes with, but you could be hit with penalties too. So guess what? Now you have these escalating layers of taxation on top. It's just a mess. So back up again, just hammer that point. If you do $100,000 conversion and you know you're going to be within the 12% bracket, you better have $12,000 on hand and do not use withholdings from the conversion if you're under 59.5.
And if you're in the 12% and you're taking 100,000, you're probably in the 22% now.
Yeah, right.
There's, so keep 20. You better have 18 or 20,000 sitting somewhere that you can pay that bill in the future, because you're probably jumping tax brackets at that point, and it's.
Now, to clarify, you cannot do the withholding from TSP. That is not part of it.
Good.
TSP absolutely tells you, and people complain about it, but to your point, it's protective for them. So if you're over 59.5, okay, I get it. I can see why. But if you're over 59.5, you can take a distribution. You just have to do it as a separate transaction. But there's still other reasons why you may not want to do that. In general. So just that it becomes a little bit less powerful when you're using money from your IRA to pay the taxes.
Do we want to talk about the safe harbor issue with that? Do we want to put that out there? Because, that's another thing too. I don't know how to, I don't want to go full nerd and read out of a textbook here to your audience, because it's complicated. But if it's a large enough conversion and it's really going to change your taxes, let me say, dramatically from what you experienced last year, that's the best way I can say it, then perhaps it might be in your best interest just to connect with the IRS and go ahead and send them that cash right away. All right. Because and if you're wondering what I'm talking about safe harbor guidelines, because the bottom line is if you get to the end of the year and your withholding from your LES is normal as you did last year, and you got this huge tax burden, you might be in violation of what they call safe harbor. I'll let you look that up. It's way nerdy and a lot of fun to learn about. So that might be of interest to you.
I mean, I'll just add to that is that absolutely. So the IRS expects withholdings to happen throughout the year. So with your paycheck, it is happening throughout the year. If you have a big, quote, income event, and the Roth conversion, that's sort of what it is an income event, then the IRS expects you to pay a quarterly tax in the quarter in which that event happens. And you can run into trouble with penalties, underpayment penalties. But I will also mention that if you do a Roth conversion and you're running into penalties, even though you paid the tax, you might need to talk to your tax preparer about changing how they recognize that income, basically tying it to the quarter in which it was done. So for example, if you do a Roth conversion in the fourth quarter, you make your quarterly payment in January 15th, you might still end up with a penalty. But if your tax preparer prepares the right form, that penalty would go away. So it's sort of, the bottom line here is that, and I think, Rob, you've made this point really well, is that it's nerdy and it's hard to understand. So if you're going to do one of these things and it's a larger amount because that makes sense for you, it might be a good year to get some help from a tax standpoint.
Well said.
Yeah, no, thanks for bringing that up, Rob. So just before we close out, wanted to kind of just run through a couple scenarios, just get your thoughts on, hey, what should this person be thinking about? So first one, let's say we got an E6, has maybe 80K in the traditional makes about $70,000 a year, excluding BAH and stuff, wants to convert, what would you tell them to think about?
Well, I'm gonna go with the biggest cop out that every financial advisor loves to use. It depends. There you go.
Always, always.
And cut. We're done, right? Sadly, it really does. I saw these here, and I apologize. I'm going to try to cop out or try to give as much as I can, because you really need a lot more context in information with this. So I would go back to, the first question I'd ask this E6 is, what do they expect their employment opportunities to be when they retire, right? So if we're talking about, maybe someone that's in the JAG or the medical field, or, pilots, those are very lucrative careers in the civilian sector. So in that case, okay, now we're talking about, all right, it would behoove you, because you're probably in a much lower tax bracket this year, or in your earning years here with the military, to go ahead and pursue these Roth conversions. But if they're going to do their 20 and get out, and then just kind of live on their pension and alone, then it might make sense to go ahead and stay in the traditional side.
Yeah, I think that's great. Just the questions you'd ask and just how you're processing it. So perfect.
And I think that would be true across the board, right? So in the as we kind of wrap up, what are the key points that you want people to remember from this conversation?
The key points is, I think when you want to try to get into a Roth, this is a good opportunity for you to better understand your current tax situation. We can go and we can play in the software as much as we want. And we can see the long-term projections, and we paint these beautiful pictures. That only really applies to how it affects you today in making that decision against the slightly opaque or slightly translucent world that we know looms out 20 to 25 years ahead of us, right? And how that affects us, and we're going to make this decision today. Do a year-by-year decision, understand your current tax decision, and then just make the best decision you possibly can. I do want to hammer one thing, and this conversion discussion in Roth, it in itself is birthed out of this really popular desire to get as much money into a Roth account as possible. I understand where that comes from. I really, really do. Okay. I've talked to a lot of folks who have everything in a Roth side, almost everything. And they're like, how do I get more into a Roth? And we're doing a Roth TSP, or we're doing the Roth IRA, and we're doing Roth conversions. And it feels good because you might have this potential quote unquote tax-free life when you get out in retirement. There's something you need to consider, in that there are a lot of tax advantages in retirement that are built in, even when you have taxable income. So going back to the conversation we had about having those three buckets, it really is a benefit to you to have options on where you decide to take income, right? When you get to retirement age, low tax brackets still exist, or will likely still exist. So if you're paying, money to get money into a Roth account, if you're paying taxes at a 22% rate to avoid 10% taxes at that lowest tax bracket in retirement, that's not a really good value proposition. Standard deductions will likely exist. Other deductions like over 65 exist. New Social Security deductions exist as of 2026. I mean, there's all these tax benefits built into your retirement that if you zero out your tax burden, you're missing out on those really low taxable amounts, right? You've seen retirees' tax bills. The average tax rate's pretty low a lot of the times. So what you're trying to save, again, difference between the marginal and the average. If you have an average retiree or normal retiree, their average tax rate might be 6%. So if you're doing Roth conversions at 22, you're trying to save taxes on potential 6% in the future. So just understand that I get the pull to be all in Roth, but you might really be shooting yourself in the foot or right now in order to get a benefit that's not going to benefit you that much in the future. I did write an article. I don't know if I can send you the link to it. It's called Don't Over Roth Your Retirement. It's about this whole thing. If you want a deeper dive, feel free. I could shoot you that link.
Yeah, we'll definitely include that in the notes. So appreciate that. And so, Rob, as we wrap up, where can people go to follow along with you, learn more, find these type of articles?
Yeah, sure. I'll just point folks to two places. As Amy was kind enough to point out, my firm name is Everman Wealth and Prosperity. The website is prosperwitheverman.com. I'm available on Facebook and Instagram, Everman Prosperity. If you search for that, you'll likely find me. I'm not very busy or very active on LinkedIn. I keep getting my hand slapped from other professionals, like why I don't respond on LinkedIn. But I am on there, but I'm not very active. And the other place to find me is a podcast with Omen Quellog, your last guest, called The Fiscal Foxhole, available everywhere you listen to podcasts. We also have Instagram and Facebook accounts for that as well, Fiscal Foxhole.
All
Awesome.
right. Well, hey Rob, we really appreciate you coming on and sharing your knowledge. This is an interesting topic, a great new feature, and appreciate you kind of walking through the ways to think about it, because that's critical. Making sure you fully understand the implications of using this new tool. And I was writing an article. I used the analogy. It's a tool. It's like a hammer. You can build stuff with it, but you can also smash stuff with it. And you need to know what you're doing to make sure you're doing the former rather than the latter. So again, Amy, anything you want to add?
Not at all. Rob, thank you so much. It's always good to talk with you. I really enjoy talking with you every time we manage to get together as a group. So thanks for your time today.
My pleasure. Thank you all.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.